Today is March 11, 2026, and as leaders gather in Brussels for Europe's independence moment, a structural earthquake is hitting the Eurozone bond market. For decades, the safety of your cash was a reliable anchor because interest rates were a policy choice. But that era just ended. European governments are flooding the market with a record 1.4 trillion euros in new debt to fund defense and infrastructure. Yet their anchor investors, the massive pension funds, are leaving the building. This has created a liquidity vacuum that is fundamentally repricing your mortgage, your savings, and your future. While the lazy money stays trapped in 0% accounts, the smart capital is locking in 3.2% yields in price-sensitive bond markets before the floor sags further. Today, we're auditing the 4 chapters of the 2026 bond reset to show you why cash is now a liability and which ETFs are currently crushing the market. If you're waiting for a bank to tell you when to move, you're already behind. Let's look at the numbers. The biggest threat to your savings in 2026 isn't a stock market crash. It's the sudden departure of the guaranteed bidders of European debt. For 30 years, domestic pension funds were the anchor investors that kept Eurozone rates artificially low. But the Great Dutch Pension Shift has changed the legal landscape. These funds are now structurally reducing their exposure to long-dated government bonds, removing an estimated 100 billion euros in demand from the system. With a projected 230 billion euros demand shortfall for the year, the price of money must rise to attract retail interest. This is why mortgage rates of 3.35% have become the new baseline across Europe, regardless of ECB deposit rates being anchored at 2.00%. For families, this marks a new era where bond yields are determined by market dynamics and demographics rather than policy choices. We are essentially moving into a retail opportunity window where individual investors can demand a premium for their liquidity, provided they move beyond the monolithic savings model and into price-sensitive instruments. Part 2. Bond ETFs versus static cash locking in the 3.2% floor. Is your cash just perking, or is it working? In 2026, the cost of lazy money has effectively tripled. While traditional European banks are lagging with low interest on current accounts, high-quality international bond funds, such as the Vanguard Total International Bond Index, are offering a 3.2% yield floor. This isn't just about a 1.2% spread. It is about income harvesting, capturing elevated starting yields without taking a directional bet on the broader economy. Short-term bond ETFs, generally defined by maturities of 5 years or less, carry significantly less interest rate risk. Part 3. The 2026 refinancing crisis. The debt trap snaps shut. Beneath the surface of this yield opportunity lies a $1 trillion refinancing wave that is putting intense pressure on the global financial plumbing. Corporations that borrowed at record low rates in 2021 are now seeing their 5-year paper mature, forcing them to pay 2026 prices for new capital. This debt trap triggers a ripple effect that hits your monthly fixed costs, from higher credit card rates to increased insurance premiums as providers pass on their own rising costs of capital. We are closely monitoring the Federal Reserve's $12.5 billion daily Treasury buyback program, which signals that the bond market is currently under more stress than it was during the 2008 crisis. In this environment, treasuries are no longer static safe assets. They are high beta expressions of global liquidity. To avoid the liquidity trap, signaled by billionaire Stanley Druckenmiller, investors must monitor repo numbers and treasury auctions as early warning signs of a system that is losing its ability to self-correct. The ultimate macro warning for this reset comes from Ray Dalio, who argues that the world's primary reserve currency is currently facing a financial heart attack. As of March 2026, U.S. gross federal debt has officially hit $38 trillion, with interest payments alone reaching $1 trillion annually. Dalio describes these payments as plaque in the arteries of the global economy, crowding out all productive spending and pushing the system toward what he calls Stage 6, the war stage, characterized by capital weaponization and the breakdown of the monetary order. We are seeing a complacency loop, where policymakers assume the bond market will always flinch. But with U.S. debt to GDP now at 125%, that confidence is cracking. In response, a massive capital rotation is underway. For the first time in recent history, international investors are becoming net buyers of euro area government bonds, seeking a haven from U.S. tariff uncertainty and the tariff time bomb that Dalio predicts will soon cascade into higher prices and squeezed margins. The Eurozone is making a strategic play for safe asset status, bolstered by the fact that the majority of the world's remaining A-rated debt is now found within the Eurozone. We are specifically watching the rollout of the EU's new SAFE instrument, the Security Action for Europe, which promotes common borrowing for defense and is creating a massive new pool of liquid assets for European family offices. To survive this transition, your liquidity must be segmented to avoid the liquidity trap, where traditional assets can lock up overnight. We are seeing a structural shift where gold has actually overtaken U.S. Treasuries in some global reserve portfolios, serving as the only true safe haven with no counterparty risk. To hedge against this Stage 6 world order, we recommend a strict 3-bucket strategy for European investors. 1. The liquidity floor. Maintain your $2,000 sanity shield in cash for immediate stability. 2. The resiliency layer. Allocate 15% to physical gold, as recommended by Dalio, to protect against currency debasement. 3. Nerve 3. By moving from a forced seller, someone who has to dump assets during a crash, to a price-sensitive buyer who demands a premium for their liquidity, you can build a structure that survives a grinding multi-year deterioration of the traditional monetary system. Conclusion: the active choice mandate. The median household in its 30s today has only $36,000 in assets, while those in their 50s have just $74,000. These are the investors who stayed passive while the markets reset. In 2026, passivity is a guaranteed loss. Short-term savings accounts offer secure but unattractive returns that fail to beat the 2.2% core inflation target. You win this year by navigating, not just owning. Secure your $2,000 sanity shield, then move your excess liquidity into the bond portfolios we discussed to capture that 3.2% yield. The system's ability to self-correct is breaking down, but your ability to act is not. Tune in this Sunday as we stress test your household budget against the Fed's severely adverse recession scenario. I'm Jenny. If you value calm, structured thinking around money and mindset, I share new insights every Wednesday and Sunday here on Jenny Insights Money and Mind. Thank you for spending this time with me. I'll see you in the next one.